YouTube channel for that. But thank you, Alpesh, for coming back. I sort of said, we want to look at the post-election markets. I know you did a lot of webinar activity leading up to the election. I think the result wasn't what everybody expected. Did that cause any big upsets in the markets, or do you see any longer-term ramifications of the sort of political landscape where we are now, and does that have any impact?
I was just saying, with the elections, what I try to get across to people beforehand was how, from a trading perspective, we look at it. Obviously, an analyst will look at it in a particularly academic way, and journalists will look at it in a different way. But what I wanted to get across to people was how we, in the trading community, would tend to look at it. And what that was, I'm just going to put my screen up to make sure you can see that. What that was we're trying to look for one-way bets, high probability bets. Now, the election actually happened to offer that in this regard. I'm not saying it was necessarily easy to do, because a lot of brokers will get in the way. They'll say, right, higher margin requirements, all of this. And it was a bit like the Scottish referendum and with Brexit, when I say high probability bets, which was this. Given the anticipation beforehand, sterling was starting to move upwards. So we knew when the polls closed at 10 o'clock, most probably what's going to happen is there'll either be some profit taking because those predictions, those forecasts which were wrong, would either come true, were wrong in the eventuality, would either come true, in which case you'd take some profits because you'd seen sterling rise, or there'd be some kind of shock horror, and as in the case of Brexit and in the case of the election, and sterling would plunge. In reality, what happened was there was the shock horror, as happened with Brexit, as happened with the election. We didn't know there'd be a shock horror. We thought there'd just be a little bit of light profit taking. The Tories would have an outright majority, and therefore there'd be some profit taking on sterling. But we knew that should there be shock horror, doesn't matter because sterling should go in the same direction. So those are the kinds of trades you want to do. What we were doing was actually, well before that, we're staying, first of all, out of the fight and all the skirmish and the volatility, and we were looking at New Zealand dollar. Anybody who was looking at my webinars would know we were saying we're loving New Zealand dollar, and people would be thinking, why the hell are you looking at New Zealand dollar? What do you know about the New Zealand economy? Nothing about New Zealand economy. We were just looking at how smooth those trends were, because we suspected a lot of money was going into markets which were disconnected to the UK as much as possible. So anyway, that's it in summary. I've got a whole load of slides to update you on, and I've also got a bunch of other stuff with the forex markets as well. I've just got to make sure that I got it all set up correctly, make sure you can see everything, and then we can get to go. So do you want me to start proper?
Yes, please do. Ladies and gentlemen, Alpesh Patel.
Thanks very much. Okay, I think and Simon, correct me and help me if I've got this wrong. People should be able to see a screen with the number 1 on it and a picture of me.
Correct.
Good. Wonderful. So many webinar systems, and I have to say, I get mixed up. Anyway, it must be my age. Right, let's get on with it. And I want you all to make sure you've got a pen and paper. You're going to need, most ideally, he says, looking for his phone. If you've got a camera phone, that's going to help you, because there's going to be some slides. I think you can take pictures actually in the system of some of the slides. You'll want to do that because there's a hell of a lot of slides and there's a lot of information in them, because we do a lot of research. It throws up a lot of stuff for us, and I love sharing it with people. Okay, so get ready to take those images on the screen using the GoToWebinar. I think there's a little camera icon somewhere in the top right or somewhere. You know, you'll find it. You'll find it. Okay, I want you guys to be your own fund managers. And the reason for that is, I can tell you, speaking as a fund manager, as a person who is a private investor, and as a fund manager, you can do it. I'm not necessarily saying you want to go out and create your own asset management company. It's a real pain in the arse and costs a shed load of money, he says with some bitterness. But what I will say is I think you can be your own fund managers, and I want to get you into that professional mindset. And like I say, having been a private investor for so long and then set up a fund management company, I can tell you, private investors have everything it takes to be able to be their own fund managers. And I don't want you to trust fund managers because they're overpaid, usually fat, middle-aged, losing their hair, but most importantly, like I said, overpaid. Your pensions are going to these people and they're not performing. Quite frankly, they're really pretty poor at performing. So you can tell from what I've just said to you, I'm going to be very straight talking about all of this. I wish I could tell you that's the new government taking over at Downing Street, led by me and my team. I'm afraid it's not. But I will be straight talking to you in this webinar and tell you the God's honest truth about the fund management industry and how you can make your own money with as little a risk as possible, because obviously that's what you're really interested in is mitigating that risk. Okay, a little bit about me. This is not really relevant, but for those who want to know, those are the the three funds, and the fourth one we're going to be launching, which are out there. We're based out of, the funds are domiciled out of Luxembourg. The offices are in London, in Brook Street, out in Mayfair, and that's just a bit of background. You know, I think it's important when you're speaking to people, they know what your background and credentials in the industry are. So private investor 20 years ago, and then trading on my own account, and so on. Most of you will know this. What I'm going to talk to you about is this. Why do we like these? Why do we like these? How do you, after this webinar, long after this webinar, generate the skills and ability to get numbers and score out of 10? That's what we do. We simplify things. Fund managers are not necessarily the cleverest people, so we like to score things out of 10. Why do we like those right at the moment? And that's something that I've run through our databases just 48 hours ago. So it's bang up to date and wouldn't change. Why do we like this? For what time frame? What kind of returns would I be expecting you to be making? Would they be around those levels of 163%? Or in the next 6 months, am I looking for you to make something more modest, like 10 or 20%? Those are the questions. And the critical factor in everything I do in all of these things, and like most business owners, I am fundamentally lazy. I didn't want to work for somebody else. I wanted to work for myself because I wanted 100% of the fruits of my labor. So everything I'm going to be teaching you is predicated on the fact I don't want you to be sitting in front of a bloody computer screen or looking at a cell phone or an iPad all goddamn day long. Now, if you want to do that because it makes you have your own little man cave or woman cave and be away from the rest of the world, that's fine. But it's all about getting a return on your time as well as a return on your money. Okay, a lot of people like to work hard. They like to sit in front of computer screens all day long because it makes them feel really important. They think, oh, look at all these monitors and look at all this. I must be doing some hard work. Actually, most investing isn't like that. I know this because the hedge fund managers, the fund managers who are my mentors, most of those buggers would go home by about 11 a.m. after a couple of hours of work. Okay, it's not because they were lazy. It's because spend too much time in front of a computer screen, you're going to do bad quality trades. Whether you've made money, in which case you'll do them out of arrogance, or whether you've lost money, in which case you'll do because you're chasing the market, so you're your own worst enemy. So that's why it's important to have a return on your time invested. Okay, and similarly, I'm going to talk about why I like these ones, these American companies, which I've just shown you the top ones that we've rated. How do we do it? How do we rate it? So I'm going to come back to this list. Don't worry. I'm just giving you a preview of what we're talking about. And if you want it out of 100, a score out of 100, why I don't think there's going to be a market crash anytime soon. Famous last words, eh? Famous last words. But if there is, and quite frankly, I don't care if there is, then why I'm going to be looking at a lot of these what some people think are overpriced, overvalued companies, but the higher rated ones. And each one of these scorings next to them is out of 100. Okay, but why I'm going to be looking at those kinds of companies. Anybody who remembers the credit crunch will know one of the reasons why we do look at some of the tech companies is because, you know what, if you've got $1 trillion in cash in the bank, if you've got $1 trillion of cash in the bank, your share price isn't going to usually fall below the amount of cash you have in the bank unless you're burning more money. Okay, so we're going to look at protection. All right, I won't go through my whole biog and all the rest of it, because people say, oh, stop talking about yourself. But for anybody who's thinking, why the hell should I bother listening to this guy? There you go. All right, some quick timeline background on me. Enough of that. Let's get on with what you're interested in, is how you can make money. Now, we're going to do a little experiment. Don't cheat with this experiment. Don't Google this, okay? I want to ask each of you, and you can put it, I think, in the chat box, okay? I want to ask you a couple of questions, and this little test, this little exam I'm going to give you is going to reveal something fascinating to you all, and it's going to surprise you most probably, which is this. Out of all this data you can see on the screen, so imagine the elections happen, and now we're looking for companies which in a volatile world, a Donald Trump world, a minority government, a Brexit, which we don't know the outcomes, and we're looking for something which is going to give us a return regardless of all of those volatile environments. So I'm not going to sit here and say to you, oh, I want you to get a return based on Brexit being hard or Brexit being soft or Donald Trump suddenly putting solar panels on the wall with Mexico. No, no, no. We're not going to try and read the mind of bloody politicians, because most things between their ears are empty anyway. Okay? What we're going to try and do instead is say, regardless of how much they F up the world and their own countries, which companies will give me a good return? And what is the basis on which you're telling me, Alpesh? Because I don't want to trust you, Alpesh. I don't want to trust anybody. What I want to do is trust your logic. Okay, so that's the basis on which we're going to do it. That being the case, tell me now, with all these facts, you see EBITDA, you see interest expenses, EBITDA or interest, blah, 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 total liabilities. Which of those factors do you think are the most important to judge the share price of this company from 2012 to 2016? And then I'm going to ask you two further questions. How much did you think the share price went up? Like I said, don't cheat. Don't cheat, please, by looking on Google or anything. And I'm going to ask you, or go down, by the way, up or down. And then I'm going to ask you, what do you think the name of the company is, just out of interest? But that doesn't really matter. What do you think is the most important thing? Is it EBITDA? Is it something called the current ratio? Is it shareholders' equity? Okay. What do you think was the most important factor to impact its share price? Or maybe you think it's none of these things. Maybe you think, oh, Alpesh, you're playing games with us. It's none of these things. It's all of these things. If it's all of these things, the next question is, well, how do we weigh what's important? Maybe you'll say it's some of these things some of the time, in which case, oh my God, might as put a bullet to our heads, because our job has become a lot harder to work out which stocks we should put money into. Like I said, I don't want to be guessing based on the whims of political outcomes, because they're too volatile, they're too dangerous. Okay, so if we then go back to the solidity of a company and think of a company like a sausage factory, which just produces numbers. All companies have one thing in common: they produce numbers, and those numbers should usually, subject to fraud, should be, and God, accountants, we hate them as well, those numbers should have some correlation to the share price. Of course, the broader economy and all these other things matter. What do you think matters in terms of what I'm showing you on screen? I don't know. Maybe Simon can see the answers. I'm not sure if I necessarily can.
Alpesh, I feel like you've got access to the answer. I'll read them out though. We've got shareholders' equity, EBITDA, interest expenses, current ratio. So shareholders' equity has more.
Okay, no, that's fair enough. Okay, so that's a good answer. Okay, so let's go with that for a second, everybody. And the shareholders' equity in this company from 2012 to 2016 went up about roughly 10%. Okay, 10%. So what do you think the share price did? Did it go up 10%? Being mindful of the total liabilities of the company more than doubled, or do you think the share price went down, or do you think the share price went up more, or what? I want you to put a percentage into the chat box of what you think the share price did from 2012 to 2016 based on those numbers. I'll give you a heck of a lot of data there. What do you think? And 5 years is a pretty good period. 4 year, 1, 2, 3, 4, 5 years worth of data is quite a long period over which to get there. And by the way, from this we'll go on to how you can make money and the amount of money you should be able to make investing, and how you make sure you're not spending more than a couple of hours doing that in a whole year. In a whole year. I know that's going to blow your mind. Okay, in a whole year. And I'm going to show you how we did it, okay, with independent tracker results, and you can see what we did. You can just pick the ones that we liked, which I've just shown you. All right, so we'll come to that. So I don't want you to think it's academic. I just want this experiment. Simon, what percentages are you getting at the moment for people saying?
Well, it's more people are thinking that the share price went up. Some people are saying they can't tell what the share price does from the fundamentals. It depends how it is traded. But yeah, more are putting their hand to say it's gone up than down.
Any numbers? Anybody said 10% up, 100% up, 1,000% up?
70%.
Okay, not bad.
I believe that must think 70% up.
Okay. So let me tell you. The point I'm trying to illustrate before I show you which company is and how it performed is this. There's a heck of a lot of data out there. Now, it cannot be the case that financial data doesn't matter at all. It cannot be the case. Oh, profitability of a company is irrelevant. Otherwise, why would companies even bother reporting any of that? If you're saying that's irrelevant, then please, I'd like to sell you some shares in my company for £1 billion each. Because obviously, if the fundamentals are irrelevant, you don't need to see the accounts, do you? So £1 billion, please. Okay, so let's say that the fundamentals, the profitability of a company does matter. The bigger problem is, well, it's only one thing that matters. It's not the only thing. And we don't know how much it matters. Okay? We don't know how much any of these things matter and when they matter. Maybe some things only matter a tiny bit, and maybe sometimes they matter more. Maybe they go out of fashion. The point I'm trying to make is this. What if there was 100 years worth of research done by, because the stock market's been around for more than 100 years, done by numerous universities, so they're independent of stockbrokers and independent of fund managers who want to always sell you the story, the market only ever goes up. Okay, done by a bunch of academics, which gave you some kind of idea of what matters and what percentage. So this was something that I looked into when I was writing my column in the Financial Times, my diary of an internet trader. As an internet trader, it was my job every week to tell people what I'm trading, and put my neck on the block, put my reputation on the block to 1 million readers worldwide. I couldn't hide in some chat room or a Facebook post, or whatever, a tweet. It was there in an international paper where if you want to be in the fund management industry, if your reputation's wrecked there, forget it, you're dead. Okay, so this is the research I looked into and published the results and so on. So let me share some of it with you before I share what we found and so how and what stocks we like and why I like the ones I've just shown you and how and what you should do, I think, and how much money, more importantly, you can make, because how much money it makes. Let me show you what the company was and how it did. Okay, there's the company. Microsoft, we've all heard of it, obviously, went from $30 basically in 2012, and it's currently at what, 60. So it's gone up about 100%. All right. Now, some of you will say had absolutely nothing to do with numbers. If it did have anything to do with numbers, Alpesh, you haven't helped as much because you haven't told us which of those numbers were relevant, and some of it might be a spurious correlation. So what if the whatever number doubled? The total liabilities doubled. Are you saying that as total liabilities double, we should look more at the share price and the share price should double? That doesn't make sense. And maybe any linkages and correlations you can find, as I said, maybe they're spurious. Maybe they're just coincidence. One thing is for sure, they're not irrelevant. There might be coincidence. So we've got to measure it across maybe 1,000 companies. Let's do better than that. Instead of just 1,000 companies, let's do 1,000 companies over 100 years. There weren't 1,000 companies in 1930 or 1920 or whatever. So let's just do it across the market. Every company we can get our data on over that period of time. At which point you might say, well, things change over time. That's fine as well. How do we account for all of that so we can get on with the important business of making money? So we came up with this task in 2004, and what we wanted to do was have investments, and I'm going to put it to you. You want investments in a market like this. We're not talking about trading now, all right? We're talking about 12-month holding periods, okay? And I'm going to show you the returns you can make from those. I'm happy to talk about trading. We'll do that in another webinar. I'm talking about 12-month results and how those, as a return on time, are the returns they'll get you. And you might say, bloody hell, I like this. I can continue with the day job and make, well, you're going to see the numbers, and they're pretty impressive. So this is the task we set at hand in 2004. I want picks like this. I want them, obviously, doesn't everybody, to go up. And what we realized is that growth is going to be vital, obviously, but how the hell do we measure that? And the problem with growth is growing companies often fall off a cliff because they've got nothing behind them. They might be growing their revenues even their profits by deeply discounting, well, revenues by deeply discounting the product, and maybe they're growing their profits by just booking things a bit early, or all sorts of manipulations. So we said we can't look at growth alone, but growth is important. And we thought, well, we want companies which are generating some kind of an income, because then their price won't drop too much. Okay, so we want to do that. And by the way, what I'm teaching you is going to be vitally important for anything you do to do with the markets. Okay, so we said we want something which generates something of an income, because if the share price drops, then you can buy the same income at a cheaper price because the share price has dropped. What I'm talking about is dividend yields. Okay, the yield would go up if the share price goes down. And that meant that the big pension funds would get into that company, so it won't fall too much. Okay, so if all of a sudden the unexpected happens, Donald Trump gets elected, David Davis messes it up in Brexit, whatever it is, Donald Trump, sorry, gets indicted, Theresa May throws another election, no matter what happens, the share price can't fall too much because the dividend income should compensate for it. And we're only looking at a 12-month period. Companies rarely go from their historic dividend yields to just say no more dividends in 12 months. So 12 months was a good outlook. It was a random number, convenient number, a number we felt was appropriate, okay, for the period we're looking at. And we thought, well, we also want companies which are undervalued, because obviously if they're not undervalued, then what reason will we have to buy them? And if they're undervalued, then they can't fall too far. So then we have this problem. How do we find undervalued companies generating good dividends and providing us with growth? And in any event, will they give us pictures like you see on screen? Companies and stocks like this, which can double up. Because we were more concerned about protecting the downside. And like I said, the best way to do that was to have that undervaluation, which begged the question, well, how do you measure valuation? And what weight do you put on valuation measures? Do you look at EBITDA? If you do, how important is it? And what the hell is it to begin with? So that was how we started. I then, as I said, in the Financial Times would give my results and post these. And then I got an independent software company, a software company independent of me, to every year from 2004 publish this on the web. Some of you all know this, and I had dinner by coincidence last night with the CEO of that company, Ionic. And let me show you what we found, and I'll go back to the stocks we like, because those are the ones which we think will make the money. The other question which we had to solve was how many stocks should you hold over that 12-month period? Okay, whether UK or US, and those were the two main markets we looked at, okay, because we could get the data for those more easily than, God forbid, German stocks, okay? So we weren't going after fashion, because we know fashions change. We didn't want to go after the fashion of China and the fashion of trying to predict. We're not in the prediction business. Prediction is where you say, oh, it'll be a soft Brexit, hard Brexit, Trump will get elected, May will get a majority. That's prediction. If you want to do prediction, go to Ladbrokes. We're in the business of looking at a company's performance, its figures, and saying those shouldn't change too much year on year. Okay, so we're in the business actually of looking at fundamental trends. Right, so then what we did is we had to answer the question, how many stocks should we hold? All right, and this is where it starts getting really sexy for the private investor, because this is how a private investor, regardless of election turmoil, manages to mimic a fund manager. And let me explain how you can do it without having to pay fund managers fat fees. Okay, and by the way, I went to university with a lot of people who became fund managers. I can tell you, I lent them a lot of money when they were at university, and I wouldn't give them money to invest today. But let me tell you the stocks. We think roughly the answer is roughly 15. Now you can see on the screen why. Let me explain this to you in extreme terms. If you only had one stock, all your eggs in one basket, the risk of not hitting your anticipated annual return is higher. If you have 1 billion stocks in your portfolio, well, adding 1,000,000,001 isn't going to make much difference to the risk, okay, or the return of that portfolio. So roughly we think the number's 15. Now, you don't need to argue with me. Is it 14, Alpesh? What about 16? Okay, because when you're looking at making money at the end of a year, you don't really care whether it was £10,000 you made or £10,001. Okay, so let's not focus on the academia. We want to be practical, pragmatic. Okay, so we're going to aim for 15. I don't actually mind whether it's anywhere between 9 to 20. Okay. Okay, some years you might say, oh, I want a bit more diversity, I want more stocks. I can't decide between these two, I'm going to put them both in. All right, now I'm going to tell you how we did this construction and the results we got, real results, independently verified. This is what happened. Now zoom in, don't worry, I'm going to zoom in. Okay, and we compared it first of all against Warren Buffett, which is unfair. I know there's a whole bunch of you who love Warren Buffett and you'd hate me for saying anything about him, and his is obviously different because he has to get a return on trillions of dollars. I could never have done this with trillions of dollars, okay, that he has under management. So we did this, and this is what Ionic, every year they've got to verify, all right? And this was the performance. Now I want to show you some interesting things. First of all, we had years where we didn't have a positive return. 2008, there was a bloody credit crunch. Anybody who tells you, oh yeah, credit crunch, yeah, made shed loads of money, okay? Oh yeah, every year, every trade, always 100% correct, 100% returns all the time, dead easy. Bullshit, okay? What I want to show you is, the next thing you want to know is, well, now, Alpesh, I'm not excited by those numbers. You got some losing years. How much is this making me? Okay, let me tell you what this makes you. This makes you better than Warren Buffett and every single UK fund manager. Now, you might turn around and say to me, yeah, well, Alpesh, I've got high ambitions. Forget those people. I want to be the best in the world and absolutely everything. That performance is better than every UK fund manager. You can see why we're in the fund management business. If you're better than everyone else, the next question is, you better get in the bloody industry. But that's not the point. The beauty of this is you don't need a fund manager, okay, to do this. That's the other thing that I got across. Let me tell you what the return is. 562%, assuming every year you reinvest it, just like if you held Warren Buffett and you kept the money in buy and hold, you just held it, you would have got, with him, 194% return. With this, 562%. Don't worry. There's no fund for you to invest in. Put your credit card away. I've given you the names of the companies already for this year. I'll do it again in a second. They're there. They're freely available. So that begs some questions. How come every year isn't winning? Well, I've answered that in a way. But more importantly, does that mean every stock has to win? No. Does that mean that you've got to be able to pick the next Google? No, not at all. We didn't do that. I'll show you some of the stocks we picked. They're household names. What we do, the principle we used was this. We want to be rich. That's what we said. We didn't say we want to be right. We didn't say we want to pick the next big thing in cloud computing or whatever. We didn't say we want to be able to forecast elections right or get into the mind of politicians. We didn't want to do any of that. We just said we want to be rich. If we want to be rich, we took the Manchester United football principle, which is we just need a team which together can win. Every single team member doesn't have to be the best in the world. Every stock pick doesn't have to be the best stock pick. We might have missed Twitter and Google and Microsoft. Didn't matter, as long as a collective team we got that return, and that return beat every fund manager. But you're saying to me, well, wait a minute, Alpesh, what's 562%? Put that into real money. Well, this is what it looks like. It turns £10,000 into £250,000 if you want 2-to-1 leverage, which is what we recommend. If you want to be just buy and hold, you can buy something and hold it for 12 months, every 12 months, and you get your 562% return over that time frame. Most people on this webinar are looking to trade, aren't you? Most of you want to be traders. The reason you want to be traders is because you don't just want to buy the FTSE 100 and sit back and say, I'll come back in 10 years, because you want a bigger return. The best of both worlds, to my mind, for most people, is to buy and hold for 12 months with a tiny bit of leverage, 2-to-1, not 20-to-1, not 2,000-to-1, just 2-to-1, okay? So what the hell is 2-to-1 leverage? So let me explain what you're seeing on screen. Those are the stock results. That's what 2-to-1 leverage does. Oh, by the way, that's what Barclays, JP Morgan said about my performance. What do you care? What do you care? It's a nice pat on the back for me. Makes me feel good, like a Facebook like, but just because you see a Facebook like on somebody else's page doesn't make you feel better, does it? No. So that's just for me. This is what 2-to-1 leverage means. And I don't care which brokers you use anyone you want. How do you leverage? And this is what people don't realize, that they can get trader-like returns by buying and holding something over a 12-month period. So I'll show you how we found them. I'll show you what we like at the moment, and the other tiny little rules, like where do you put the stop loss, what if there's a market crash, and so on. And the rules are really simple. We kept it simple because, like I said, our philosophy was, how do we get rich? Our philosophy was not, how do we create complicated systems? So how do you leverage? £100 goes into account. Most brokers, whether it's CFDs or spread betting, will give you 20 to 1 leverage. Okay, wait for me to explain. 20 to 1 leverage. So £100 becomes £2,000 worth of stock you can buy. Because what the broker does is, if you give me £100, I'll lend you the other 1,900 at an interest rate, which won't be too exorbitant, okay, because interest rates are low anyway. Now, if you then put in an extra £900 as cash into that account, you've put in £1,000 cash, haven't you? But you've only used £100 of it to buy £2,000 worth of stock. So basically what you've got is £2,000 worth of stock and £1,000 of capital. It's what hedge funds do. 90% of our money is kept in cash because we want to bring down the leverage, okay? Because leverage increases risk as well as reward. So this is then just 2 to 1 leverage. So all you've done is you've kept £1,000 in the account and you've got £2,000 worth of stock. That's 2 to 1 leverage. Got it? Most brokers on CFDs or spread betting will let you do it. For every £100, if it's 21 to 1 leverage, this is what you do. Right? The maths is pretty straightforward. Should be straightforward. With those picks, that generates that return. Kill the fund manager. You don't need any of them. Okay? Because you've got £250,000 return on a £10,000. Now, I know some of you want to do that in a year. You're saying, oh, Pesh, £10,000 account, can I make £250,000 in a year? No, this is not that webinar. All right? Okay. So the next question is, well, what did some of these companies look like, Alpesh? What did you do? Did you have some insider information, some insight into the next Twitter, whatever? What did you see in 2004 that the rest of us didn't see? Did you see the credit crunch and all of this? No, wasn't any of that. It was the same scenario as it is today with the world and its volatility, which is we just looked for what the hell would make us rich. We came up with these companies. Now, I didn't know anything about WPP, okay? I didn't know anything about British Polythene Industries. It wasn't an insight into the sector or anything like that, or, oh, they've got this new contract in China. You know, the usual crap you read in Investors Chronicle, Shares Magazine, or dare I say, the Financial Times. Those are great for journalists and analysts, all right? But as an investor, I don't give a shit what the newspapers say. What I care about is what I'm going to show you next, which are the numbers that the company's producing and the weight to give them. It isn't that their numbers are irrelevant. It is some of them are irrelevant, and it's knowing which ones aren't based on 100 years of research on about 1,000 odd companies. So that's what I'll show you next. But these were the companies that came up, and I really want to get this across to people because they find it really mind-boggling. They said, well, how come you didn't care what British Polythene Industries did? And in 2000 and whatever year this was, 2013 in this case, what the hell was happening in polythene? Do I have to become an expert? No. We're data mining. Most of you will know data mining is a big thing. It's a big buzzword at the moment. Bellway Galliford Try back in 2013. Oh, Alpesh, that was clever. How did you know about the housing boom? Wait a minute, Alpesh, that wasn't clever. Everybody knew about the housing boom. Listen, guys, I didn't give a damn about what was happening in the economy. I cared about the numbers which were generated. Okay? And that's what was happening. Brammer. I still to this day don't know what the hell Brammer does. I confess. I know what you're all thinking. Wait a minute. You column in the FT, your own TV show, and you don't know what Brammer does. Should you not know what every company does and every figure? No. I care about making money, not about being an academic. Okay? And this is a more typical example. All right? A more typical example. And I'll show you what we do when the investments over a 12-month period don't go right and how we manage to protect ourselves. Normally, it takes quite a long period for the stock to move, and then it grows. You know why? Because it can take some time for the company to find value. Remember, we're looking at companies which are undervalued, but also generating some growth. So it can take quite a bit of time, and some, like this, can have a bit of a false start. We do not review. If you review in 6 months or 3 months or whatever, you know what's going to happen? You're going to fiddle. And men, and I've got the research to prove it, men are more likely to fiddle, maybe because they walk around with bits hanging off them, more likely to fiddle than women. Women tend to make better investors. There's academic research to prove it, okay? So you don't look at it for 12 months, all right? This is all blowing your mind. hate Cineworld. I hate going to Cineworld. I like View. I don't like Cineworld. But it came up. The numbers came up. And I got to say, thank you, Cineworld. Right? So, you know, Wilmington, still don't know what they do. Is it glass? I can't remember. Somebody had told me. Anyway, 8 months of doing nothing. Then all of a sudden, bang, the rest of the market sees what we saw was the hidden value. All right? Mia's group, and so on. And I'll give you a typical, this is 2013. Wasn't the worst year, wasn't the best year. All right? You can see F&C down. Glencore down. Oh, Alpesh, why didn't you get out of Glencore early? Because I didn't know whether it was going to go back up. So where's the stop loss? The other rule we applied to this simple system was this. And I'm going to say this just once. If any stock went down 25% from where we entered it, fixed stop loss, fixed, okay, 25%, we went to cash for the rest of the year in that. So we told the broker at the start, we bought this at 100. If it goes to 75, go into cash. That's it. Now, you could say, why 25? Why not 20? Why not 30? Why fix? Why not trading? Why into cash? Why not reinvest it? I'm sure you can do better than I've done and turn 10,000 into $1 billion. Good luck to you. All I'm saying is we wanted a simple system which made us money without making us academics. So what was that? How did we do it? This is how we did it. I'll just show you, and then I'll give you the stock names again. Okay, and this is what I think is the best way for you to learn about the markets and what no fund manager will ever tell you. A fund manager wants to, and you see the adverts from Framlington, Aberdeen, I don't know, name some more. I zone out when I see them. You know, when you're driving your car and you sort of see all of these, you know, names everywhere, because they spend a fortune of your money sponsoring Wimbledon and all those things, and Rolex and all the rest of it. It's your money. It's your money. Thanks very much. Okay, that's been spent doing all of that. And what we discovered is they're a marketing machine, and because they're a marketing machine, these big fat fund management offices, okay, what they do, take Newton, okay, go to their offices if you don't believe me, plush offices, all comes out of your fees, okay. What they do is they want to sell you three things, don't they? Why should they sell you one when they could sell you three? All right, they want to sell you a value fund, a growth fund, and an income fund. So we thought to ourselves, well, why can't we have all three in one? Why do we need to have three? After all, if it's an undervalued stock, it can't fall too far, but if it's got growth, it can go up, and if it's generating income, then at least we're getting paid, and again, it can't drop too far. But then that begged the question, what the hell's important? What numbers do we look like? Do we go through? So we looked at the research, and we went through everything, okay? And then we settled upon certain variables which historically we found were helpful. And I'm going to tell you, I'm going to let you into a few of these. I'll tell you what was shocking, okay? What came out as shocking was, I'll give you one example. We found that price-earnings ratios were actually important. They might say, oh, that's a bit, thanks, Alpesh. They were important, but it wasn't their relative values. It wasn't what a price-earnings ratio was relative to the sector or to its historic self. It was absolute numbers. Now, you might say, what? That doesn't make sense. For those who know about PE ratios, you'll say that doesn't make sense. You can look up the research. It's shocking. Then you might say, well, Alpesh, that means you're not going to look at a whole bunch of technology companies because they have ridiculously high PEs. I know, and we still outperformed the market. I think it kept us out of a lot of trouble. Hey, Warren Buffett doesn't look at a whole bunch of technology companies. So if I was going to put some secrets into all of this, one, hard fixed stop loss. Two, let's look at some of these things that we found. So for valuation, we knew that there were certain things like PE, like PEG, but it was absolute numbers, not relative. We knew with income it was dividend yields, but to know the range, okay, and we knew with growth, the two key things we looked at was year-on-year revenue and profit growth. Okay, these other things were important, but the weighting was so small that actually if you removed it, it wouldn't make much difference to the portfolio picks that came out. So then what we did, okay, let me just zoom in. We went through everything. So how did we manage our risk? Well, I told you. We made sure the risk management was that no individual position, okay, could go beyond a 25% loss. Now, if you divide your money, let's say 14 stocks, for argument's sake, into 14 equal lots, remember that, 14 equal lots. Oh, Alpesh, doesn't that mean you would have, why didn't you put more money in one company and not another? Guys, it works. 14 equal lots, okay, because it's an equal team. And if any one of them drop 25%, guess what happens? 25% of 1/14 of, say, your £1,000 or £10,000 or whatever means you'd only lose 1.8% of your total capital. That's pretty much the same risk of a loss on any one fund's individual investments. I'm getting a bit technical, but just so you know, 14 positions, 25% hard stop loss gives you very, very good fund manager-like risk management, amazing risk management. Now, here's the other thing. Alpesh, what about transaction costs? Okay, actually, it's not a high turnover market. Let me tell you how fund managers screw you. Virtually every fund manager out there will have a rebate agreement with the broker through whom they are making the trades. Now, a fund manager will not say, oh, I'm churning. What they'll say is, oh, yes, I have to do a portfolio rebalancing, you know, and all of this. They're churning because they get commissions and they earn income. I know this from inside the fund management industry and the brokerage industry. When you, like I said, when you write for the Financial Times off the record, people are going to tell you a lot. If they don't meet their numbers, they're going to churn. Okay, they're going to sell. Is it criminal? Yes. Oh my God, Alpesh, you've discovered criminality within the financial services industry? Yeah, so did the Serious Fraud Office with Barclays. Okay, so why you want to be a fund manager? You're your own boss. You don't have to deal with any of that bullshit. Instead, you get to hold those stocks for 12 months. So which were the numbers? So what we did, we ran through all of this, valuation criteria, income criteria, growth criteria, we weighed them, and then we just turned everything, it's a pretty simple mathematical process, into a score out of 10. So like I said, these are the ones bang up to date for the next 12 months. Now, you might say to me, well, which 15, 14 should I pick? It doesn't matter. Alpesh, what if they're all concentrated in one sector? Well, we didn't do the correlation analysis because we felt if we're concentrated in one sector, we've got two in one particular sector, that's probably because that sector is bloody good and going to give us a great return. Yes, there's some concentration, but we also knew the difference between 14 and 15 stocks, because we had two in one sector, let's say, isn't too bad. All right, so just use your common sense a bit. Don't put all 14 into one sector. You probably won't end up doing it. Right, but there you go. Now you might say, well, Alpesh, what about what about Spectra Systems? They're already up 100%. We didn't care what they'd already performed. We're looking at what they're doing now. Even if they've doubled up in price, they may double up again. Some of you may say, no, I don't want that. I want the ones which haven't gone up so much, like Playtech, for instance, okay, or whatever. So I'm not recommending any particular ones. Remember, with any stock recommendations, please take financial advice on what's suitable for your portfolio. Please don't remortgage your house and say, oh, I'm going to put everything into this. Those are the UK ones. So I said scored them out of 10. Those are the American ones. Okay, now remember, there isn't a story. People love stories. Oh yeah, so let me tell you a story about Brunswick Corporation as to why it's going to do really well. You all want to hear the story. You want to hear that story of, oh, how I met the CEO and over a pub drink, he told me about this huge contract out of Saudi. Well, none of that happened. Okay, we look at their numbers. I won't say numbers can't lie. It's just that I'd rather do that than do what your fund manager will tell you. They'll give you a whole bullshit about, oh yeah, well, we meet the directors of the company and make sure it's been run properly. Really? Really? Because that helped you at the credit crunch, didn't it? Even the numbers didn't help us at the credit crunch. When all hell breaks loose, and it might have to be election with Brexit or whatever else, the only thing that helps us is we didn't lose too much money. We were down 18%, but over that period of time, we're still turning 10,000 into $250,000. Okay? I'm going to show you another way. I've given you a whole bunch of numbers. I'm going to give you, if anybody's interested, out of 100, these are the scores based on similar kind of criteria what I've mentioned. It's just a different way of running the algorithms, okay? Because some of you might say, I don't like any of these, Alpesh. Okay, well, maybe you'll like some of these. Take a picture, all right? And you might say, oh, Alpesh, I don't want Microsoft. Give me some I don't know. Tell me something I've never heard of. So let me do that. Let me give you some you've never heard of. Let me give you a completely different approach, which is a thematic approach, okay? Before we go into the Q&A. What we look for, if we're looking at themes, right? And I'm going to give you just names now, and we're going to do this in 5 minutes. Some people say, Alpesh, give me a good theme. I say, hey, cybersecurity, they can bring down the NHS. So we look for good trends. We look for companies which are hidden from, they're not necessarily household names, but nevertheless are popular. In other words, in the industry, they're well known, and so on. They're big enough players and so forth. Okay, now I'm not going to go through all of these. Network solution, I didn't know cyber's divided to network solutions and endpoint solutions, but what I can do is say, well, out of these, there's some interesting numbers here that I want to look at in more detail. Cloud computing, another good theme for those who like a thematic approach, trend, hidden, popular. And I'd probably say within this, I'm getting interested in data networking. Why? Because as a collective, there's quite a few companies. It's gone up fairly well. I probably don't want to go into the loss-making ones. Though some of you might say, oh, Alpesh, those are laggards. They might get taken over. I probably don't want to go for the biggest mover either. Somewhere in between, which is something which has gone up in a sector which has gone up, is a rough rule. You might have a different rule. You might want to play around with it. Feel free. What I'm saying is these are themes you might want to look at. Modern warfare. Again, after this election, I'm not going to blame the election, but maybe the election in America, maybe warfare is something we want to look at in more detail. That's how it's broken down. I'm not going to say to you, oh, you know what, Booz Allen are doing a lot of clever things, but I certainly want to consider IT services and consulting in this area because they're certainly going to be needed and wanted, not just necessarily hardware and so on. Okay, not necessarily just weapons. It's a very top-down approach, a thematic approach. The next one, the final two, wearable tech. Well, if nobody had told me, I would have said, and I'm wearing one now, not that it does me much good, I'm wearing a Fitbit. Okay, I'm wearing a Fitbit, and you can see why the share price is down, because I'm more of a Fatbit than a Fitbit. But I probably look at, yeah, consumer devices, sector's gone up. I'm looking for companies with a good trend, popular, but yet hidden from public sight. So Fitbit wouldn't fit into that because it's in public sight. Probably something like Copin, never heard of it, but it's making displays. It's not the biggest mover, it's not the lowest mover. All right, so you can see this is a far simpler approach. It's a more artistic approach. This approach is going to appeal to those of you who are arty-farty. The original approach I gave you is going to appeal to you who are a bit like me, a bit more numbers. I want to crunch the numbers, like I showed you the FT column, do the maths, okay? But I wanted to show you this. Guess what I'm staying away from? Now, you might disagree. You might say, no, solar will come back. Solar companies, not just because of the Paris Accord, but given that clean tech is important, probably more interested in smart grids. I don't know much about smart grids, but I do know Badger looks interesting. Not the biggest mover in the sector, not the smallest. Not doing too badly at all. It's just a different way of observing all of this. Now, what I want to do in closing before this is, most of you don't know this, June 23rd is International Widows Day. Okay, what do you care? Just so happens I do. So how can I connect that up to you becoming a fund manager? This is what I want from you guys. I want to get this for you, 10,000 to 2016. Remember how I said to $250,000? Remember what I said? 12-month holdings, so we're not spending much time. You do your picks. You might do it today, 22nd of June, until 22nd of June 2018. Or you might do it next month. But it's always a 12-month holding, 25% hard stop loss. So you're not in front of the computer. Now, you might put that away and then do trading. So you've got an investment portfolio and a trading one. The reason I want you with your investment portfolio to have just 2-to-1 leverage is it'll give you better returns. If you're going to work hard, you might as well do that. For those of you who want to learn how to be a fund manager for yourself, want more than just the stocks I've given you, okay, and actually, Alpesh, I like what you've said. I like a bit of this. There's a way for us to improve your education and the education of children of widows, and it's UN International Widows Day. And I came up with this idea with Simon, and I'm grateful he's given me this time today. We thought to ourselves, and we asked about 100 people over a period of time, what do you think is the most important way to learn? They said, well, we want to learn from home, want to do self-learning, we don't want to go to hotels, we want lifetime learning, we don't just want it for while we're there, we want a regulated fund manager to tell us, we want access to them, we don't want to pay something every day, every week, every month, and so on. We want a little exam if we want it, don't have to take it, all of these things, okay? And so we put something together. That's just a little bit of it. That's just a tiny, tiny portion. It looks like this. Put this curriculum together, okay, with videos, with articles, with exams, with being taught by me, and all of this. And then we thought, well, Simon, how can we, look, we don't want to be in the online course business because we've got better things to do. Simon's got a business to run. I've got an asset management company to run. How can we turn education into something good for other people? For 5 years, I've been chairman of the Lombard Trust. And the Lombard Trust, set up by Lord Lumbar, supports widows and orphans. And my co-chairman is Lord Villamoria, who happens to be an investor in my hedge fund. and he is founder of Cobra Beer, so you might have heard of it. Given that our goal is this, by giving people all of this education, the exams, the live event invites, the webinars, there's no daily, weekly, monthly cost, lifetime mentoring, career advice, and connections to me through LinkedIn, and come and meet me as well. We thought, well, how do we do some good with this? And what we did is we put this together. Simon has been great at giving me time on this and promoting this. Okay, all the profits go to charity, all right? Go to the Lumbar Foundation, which cares for widows and orphans. And funnily enough, by pure coincidence, it was Cherie Blair yesterday, and Cherie is one of our patrons. And we were at dinner at my old inn, Lincoln's Inn, yesterday. That's the link. That's 50% off with the coupon. That coupon's not going to last very long, but just so you know, okay? And it cuts the price from basically $2,000 to under $1,000, or you can do it in installments. There's a 30-day money-back guarantee. If you want to learn more of everything that I've said, you got excited about it, and you thought, wow, Alpesh, that's great. Okay, and if you didn't, hey, no worries. And some credentials there as well about me. All right, like I said, all profits are going to the foundation. I'm co-chairman. I've been co-chairman for about, I think it's more than 5 years. I think it's about 8 years, because my company has been, Profinium has been a donor to the foundation. And like I said, June 23rd, tomorrow, is International Widows Day, which the UN granted us. We were the ones lobbying for it. It was actually Lord Lumber who lobbied for it all. I can't take any credit for that at all. He did all of that. But there's the link. There's that. And this is what we wanted to do. This is what we wanted to get across to people. Okay, because there's people out there who just want to know a stock. They say, Alpesh, just tell me what you like and what you don't like and all the rest of it. I just realized I haven't even shown you the Forex stuff that we're looking at, which I can do in a second. I think there's a couple of minutes. Okay, this is it. Okay, this is where we fit in. And we don't think there's anything else like that out there, but equally, we don't want to be in the training business. So we created all the content, the course, online, bite-sized, 24/7, you can do it. And we made sure it had all these credentials, and basically no brokerage, nobody else has these credentials. So we thought, well, if that puts us up there, let's do something really good with that education. Let's make it available at a reasonable one-off price, and just give the money to the charity, because then we can take from the educated West to widows and orphans around the world. Anyway, that's that. Most people don't care about the charity part. Okay, that's fine. You don't have to worry about it. It's 50% off in any event. That's where we fit in. Okay, at the this is where costs are going up, and this is where quality is going up. That's how we positioned ourselves, and this is where we think pretty much everyone else is. They're either higher cost or certainly lower quality. So I hope you like that. Hope you liked all of that. I'm just going to quickly just show you what's happening for us, by the way, on the main currencies. On euro dollar, because obviously election. Okay, we've got a long position on this at the moment. Let's go make a note. Yeah. Now this is the daily chart. So each one of these bars is 1 day. The green up arrow is the entry point. Okay, I'm going to show you slightly longer term, which is the weekly, and the weekly continues to show us good upward moves. All right. Euro dollar obviously popular. There was something else I wanted to show you. Sterling US dollar as well. It's come back a fair bit, as you can see, but the trends tend to be quite smooth. Again, daily. I'm showing daily because showing for 5 minutes isn't really going to help you, is it? And US dollar Japanese yen has been an interesting, good one for us because it's just got the smoother trends. And again, we're long on this. What are we doing? It's avoiding all the problems around the volatility around the election. Because this is the direction it's going in. That's what we're seeing. It's not based on a fundamental analysis. It's based on trend following of that. Simon, do you want to take control on that before I completely run out of time?
Yes, Alpesh, thank you very much indeed. Great presentation. We've just got a couple of minutes before we run out of time. There are a couple of questions. One of them is quite technical, and I think it might be better if I email that to you.
Yes, no worries.
Because it's all about the percentages and stop loss. Someone needs a bit of clarification on that. So I think I'll email that question to you. Jacopedia, we are on top of that, but it's going to be too technical for Alpesh to be able to get into in the last couple of minutes of this.
Sure, no, feel free.
But thank you, Alpesh. Really appreciate you taking the time out, your busy day, and as always, it's been a real pleasure. And that Fitbit is working. You're looking very sharp. Don't be so hard.
You're too kind. You should be a fund manager.
Well, you'll notice that my webcam always stays off. Yeah. Say no more. Alpesh, thanks again. Speak to you later.
Thanks, Simon. Thank you.
Bye.
See ya. Bye.